As widely expected, the U.S. Federal Reserve held its overnight rate steady for a third consecutive meeting. Joining me now to discuss is TD economist Maria Soloviova. Maria, thanks for joining us.
Thank you for having me.
So the Fed kept interest rates steady in the face of persistent tariff pressures and ongoing market volatility. What stood out for you today?
Well, we kind of knew that this would not be your prime time television like it always is. So we expected pretty much, the Fed remaining, very steady in where they were before, keeping communication very straightforward. What stood out is the fact that they, made it very specific in terms of the risks to both high unemployment and high inflation. And they reemphasized it. We knew that that was the case already. They just reemphasized it. They said that uncertainty is definitely higher right now. So basically gives them enough wiggle room.
Okay, so let's talk a little bit about that. The Fed does appear to be facing slowing growth on one side and inflation pressures on the other side. What does this mean for the Fed's path forward?
So this means basically they will try to maintain status quo for now in the short run. It is definitely a very difficult position and not to give any indication, that they are ready to cut rates currently. So we expect that the Fed will be probably delayed in their decision, given that they need to see hard data evidence, specifically in employment, so slowdown in unemployment growth. And they also are very cautious about inflation expectations, inflation measures overall, given that we have tariffs on the table, and also inflation expectations. So in the short run, we are seeing a bit of an uptick in inflation expectations, not so far in the loan inflation expectations, but if that starts to rise, they will be definitely paying attention to that.
Okay, now we did get some hard data on the U.S. economy. It's surprisingly contracted in the first quarter. How likely is it at this point that a recession is on the horizon for the U.S.?
So I think it's anywhere between 40 and 60%, depending on who you ask. So let's call it a coin flip at this point. We are not projecting inflation, or we're not projecting a recession in our forecast, but we did mark down growth by 0.5%. Relative to our March forecast, so it's quite significant. So there is, there is a chatter about recession. That's always the case, and of course, it is still on the table. It's just depending on how quickly there is a resolution on, trade negotiations, what kind of deals we see, or even at least indications of what kind of deals we will see in the future. So that still creates uncertainty.
All right, let's talk about the jobs market, because it has been pretty resilient in the face of all this uncertainty, this tariff uncertainty, economic uncertainty. What do you attribute that to, and is that trend likely, going to continue in the future?
Yeah, so it's a little bit, we know jobs report is usually backward looking, and that's one of the reasons the Fed is going to stay on hold for a bit. They want to see definitive indication that employment is slowing, that there is some sort of, clear path to the slowdown, because we already had a couple of head fakes before. So they would like to see that, we do see that businesses have different approaches. And given that we had just recently the supply shock during the pandemic, they're maintaining, their employment count. Currently, they try not to lay off workers. It's very difficult to hire them back on such a short notice if all of a sudden we have this trade uncertainty dissipate further. So they're trying to work it through maybe less hiring, and that's why you see fairly decent numbers in payrolls so far.
Okay, let's talk about the U.S. dollar, because with all this uncertainty, not surprisingly, the U.S. dollar has come under pressure. Where do you see the currency going from here?
So far, we've seen a bit of an adjustment, and it's probably, the expectation was that with tariffs you will see upward pressure on the US dollar. But there are some additional things that are underlying the weakness, and some of it is related to, obviously, trade negotiations and the Liberation Day overall. Some of it has to do with the expectations that investors will rebalance from, diversify away from the U.S. and maybe going to different economies as well. So this could be also, we have to factor in that the fact that the U.S. dollar had a very significant run for many, quarters and years. So now it's kind of an adjustment to a lower level. We do, however, expect that if the economy slows according to our expectations, and we have, so far we have on the table 3 cuts for this year. So if that happens, then we think that US dollar will adjust just on the interest rate differentials, right? So at this point, we still have high level of the monetary policy. So if that adjusts, then we will see about additional 3% decline in US dollar, but it will depend in terms of cross currencies. It will be a little bit different for different countries. Let's say for Canada, we see less of that because it has higher risks of trade difficulties in trade negotiations, and then some countries may see different dynamic there. But overall, we think a little bit more weakness to US dollars on the table.
Okay, now you mentioned you see 3 cuts this year. What are the indicators that you'll be watching closely over the next few weeks and months that could swing the Fed one way or the other on rates?
Definitely employment, so we will be watching that. And any type of indications, even on high-frequency data, would be useful. So we are definitely looking at claims, jobless claims.
Some of the leading indicators.
Yeah, so some of that, potentially some of the median number of weeks staying in looking for a job. So those indicators as well are useful. And overall, obviously, employment reports. And like I said, it's probably going to be difficult to see it. We don't expect a large swing in the next months, and the Fed will definitely want to see a little bit of a trend as well. So we'll be watching that closely. We'll be also watching inflation expectations, so both market and survey, because that's an important factor for the Fed as well.
Maria, thank you very much for your time.
Thank you for having me.